Crown Holdings, 130 years old, started with a bottle cap, and today the company makes the can holding your Red Bull or your Monster Energy drink.
The founding story is genuinely remarkable. William Painter invented the bottle cap in Baltimore in 1892 and built a company around that single innovation.
That company became Crown Cork and Seal, then Crown Holdings, and it never stopped innovating around how you seal and package a liquid product at scale.
In 1936, Crown produced its first aluminum can. At the time, cans were a novelty. 70 years later, they are the dominant global beverage format.
Today, Crown operates in 40-plus countries with more than 200 manufacturing plants, one of the most geographically diversified packaging companies on Earth.
FY 2024 revenue was $11.8 billion. America's beverage is the largest segment at about $5.9 billion, 50% of total revenue. Europe and Asia fill the rest.
The end markets are beer, energy drinks, sparkling water, spirits, and food cans. Beer was the anchor for decades, but energy drinks are the growth engine now.
EBITDA margins run around 15%, meaningfully better than most heavy manufacturers. Pass-through commodity contracts protect Crown when aluminum prices spike.
The energy drink tailwind is real and durable. Red Bull and Monster are growing globally, and both are almost exclusively packaged in aluminum cans.
Crown is one of only 3 global-scale beverage can producers. At that volume level, major brands have very few alternatives, that is, pricing power.
The sustainability angle reinforces that moat. Aluminum is infinitely recyclable, which major brands now require from their packaging partners for ESG compliance.
Ball Corporation is the direct peer comparison. Same end markets, similar geography, comparable margins. Ball has slightly better beverage mix, but also more debt.
Silgan and Graphic Packaging round out the peer set, but they skew toward food and paperboard, a different risk profile and less energy drink exposure.
The leverage story is central to the Crown investment thesis. The 2017 Signote acquisition loaded up the balance sheet, and the 2022 divestiture began unwinding it.
Crown sold Signote Transit Packaging for $2.6 billion in 2022, sharpening the portfolio and handing management a clear path to getting debt under control.
Net debt to EBITDA is running around 3.8 times. The market wants to see that below 3 times. That is when the capital return conversation gets interesting.
Tim Donahue took over as CEO in 2019 and has been disciplined about capital allocation, buybacks over dividends, no large M&A, steady debt paydown.
Donahue came up through CFO roles and led the Signote integration. He is a financial operator, not a builder, which is exactly what the company needed post-acquisition.
His track record since 2019, divested non-core assets, reduced leverage, and let the beverage can business do what it does, generate steady free cash flow.
Free cash flow conversion runs around 70% of EBITDA. That is the engine. As leverage comes down, more of that cash becomes available for shareholders.
At roughly $85 a share and a $10.2 billion market cap, Crown trades at a modest discount to Ball, mostly reflecting that higher leverage ratio.
The bear case, a sharp slowdown in energy drink volume or aluminum cost spikes that the pass-through contracts do not fully offset for a quarter or two.
Also watch European economic weakness. The European beverage and food segments together are about 30% of revenue, so a demand slowdown there matters.
The bull case is straightforward. Energy drinks keep compounding globally, leverage crosses below 3x, and Crown restarts a meaningful buyback program.
10-year return of around 63% lags the S&P, but understates the quality. Crown has compounded through commodity cycles and a major acquisition hangover.
The stock is up about 12% in the last 12 months. The market is patient, waiting for that leverage milestone before rereading the equity more generously.
That's the Crown story. 130 years of packaging innovation, from the bottle cap to the energy drink can powering the global market.
On the bridge, we look at the energy drink tailwind and whether Crown's leverage reduction opens up the capital return story.
Crown Holdings just delivered a clean dual beat in their seasonally weakest quarter. Q1 2026 EPS of $1.86 against a $1.75 estimate. Revenue of $3.259 billion versus $3.034 billion expected.
That's a 6.3% EPS beat and a 7.6% revenue beat. The stock should trade up 6 to 9% post-close. And remember, this is a company that traces its roots to 1892 bottle cap innovation, now printing premium beverage can economics in the softest seasonal window.
The metric strip tells the story. EPS actual 186, estimate 175, beat 11 cents. Revenue 3.259 billion, actual 3.034 billion, estimate beat 225 million. Year-over-year revenue up 12.9%.
Q1 is the quarter where Crown should look weakest. Beverage can volumes are seasonally light, fixed costs spread across less throughput. A 186 print here implies operating leverage we haven't seen in 2 years. The Q1 2025 comp was 165.
12.7% EPS growth on 12.9% revenue growth. Margins held the line, didn't expand dramatically, but didn't compress either. That matters because the bear case has been aluminum cost squeeze and Europe drag.
Neither showed up. Let's unpack why.
First development. America's beverage volume momentum is real. The segment that drives roughly half of consolidated revenue grew high single digits, and energy drink can demand was the marginal driver. Red Bull and Monster keep adding shelf space SKUs.
Second, aluminum pass-through mechanics held. When LME aluminum moves, Crown contractually passes it through with a lag. The market worried the lag would compress Q1 margins after a late 2025 aluminum spike. It didn't. Hedges and contract structure absorbed it.
Third, European beverage stabilized, not growing but not deteriorating either. That's a win given the consumer backdrop. Europe is roughly 30% of revenue, so flat is fine prevented a guidance cut.
Fourth, transit packaging, the smaller segment, surprised slightly to the upside. Industrial demand for steel strapping and protective packaging picked up modestly. Not a thesis driver, but it removed a tail risk.
Net of all four, this is a quarter where every segment cooperated. That rarely happens, and when it does, you get the kind of beat we just saw. Revenue $3.259 billion, up 12.9% year over year, against the Q1 2025 base of $2.887 billion. That's the strongest Q1 in the company's recent history and exceeds the Q3 2025 print of $3.202 billion.
EPS $1.86 matched the Q3 2025 high. The trailing four-quarter EPS now rolls to roughly $6.60 from $6.40 pre-print. EBITDA TTM was $2.049 billion, and this quarter likely adds another $55 to $60 million on top of trend.
Gross margin 18.3% on the trailing basis, and Q1 looks consistent with that. Operating margin 13.2%, EBITDA margin 16.6%. These are industrial packaging numbers, not tech numbers, but they're best in segment.
The forward EPS projection is what matters now. FY 2026 consensus was sitting at $7.50 to $8 before today. After this beat, expect upward revisions toward 8 to 8.25. That moves the forward PE from 14 times to closer to 12.5.
Operating leverage is the headline. Revenue grew 12.9%, EPS grew 12.7%. They moved together, which means margins held even as the cost base scaled.
And free cash flow conversion at roughly 70% of EBITDA implies the trailing FCF is approaching $1.45 billion. On an $11.5 billion market cap, that's a 13% FCF yield going in.
Pillar 1. Energy drink category compounding. Red Bull and Monster combined are growing high single to low double digits in unit volume globally, and Crown is the structural beneficiary because aluminum cans are the only viable package format.
Pillar 2. Leverage crossing 3 times unlocks capital return. Net debt to EBITDA at 2.6 times currently, down meaningfully from the post-Signode era. Once management sees a clear runway below 3, the buyback restarts in size.
Pillar 3. ESG tailwind on recycled content. Aluminum cans hit roughly 75% recycled content versus P plastic at 15 to 20. Brand owners migrating SKUs from plastic to aluminum is a multi-year volume tailwind.
Pillar 4. Pricing power from oligopolistic structure. Crown, Ball, and Arda are the 3 global-scale beverage can makers. 3 players, capital-intensive plants, pricing discipline. That's why margins held through aluminum volatility.
Pillar 5, operating leverage as volume grows. Plants are largely fixed cost. Every incremental can over baseline drops more to operating income. We just saw a clean demonstration in Q1 with 12.9% revenue and 12.7% EPS growth.
Risk 1, energy drink volume deceleration. Category growth could moderate if consumer wallet pressure intensifies or if functional beverage saturation hits. Crown's growth thesis depends on this category running another 3 to 5 years.
Risk 2, aluminum price spike windows. Pass-throughs work on a lag. If LME aluminum spikes and stays elevated through a contract reset cycle, there's a quarter or two of margin compression before pricing catches up. Q1 dodged this bullet. Not all quarters will.
Risk 3, European economic weakness, roughly 30% of revenue. A consumer-led recession in Germany, France, and the UK could turn flat European beverage into down mid-single digits, which would clip 10 to 15 cents off annualized EPS.
Risk 4, execution on leverage reduction. Management has guided to below 3 times. If working capital swings or CapEx slips, the timeline pushes from late 2026 into 2027, and the buyback narrative gets delayed.
Risk 5, capital return timing. Even when leverage hits target, the board could prioritize a tuck-in acquisition over buybacks. That would be a sentiment hit because the market is positioned for repurchase, not deal-making.
Crown's main rivals are Ball Corp at ticker BALL, 61.71 a share, 16.4 billion market cap. Silgan at roughly $50, 3.5 billion cap. Graphic Packaging around 23, 7.5 billion. Amcor at 10, 13 billion.
Crown trades at roughly 14 times forward EPS pre-revision, dropping toward 12.5 post-print. Ball trades at 16 times forward. Silgan at 13, Graphic Packaging at 11, Amcor at 12.
The relevant comp is Ball. Ball has slightly better beverage mix purity and is further along on aluminum-only positioning. Crown has more energy drink exposure as a percentage of beverage and modestly higher leverage.
The valuation gap is the question. Crown at 12.5 forward versus Ball at 16 is a meaningful discount. Some of that is leverage, some is European exposure. After today's beat, the discount looks too wide.
Silgan and Graphic Packaging are secondary peers because their format mix is different. Silgan is metal food cans and closures. Graphic is paperboard, useful for sentiment, not for direct valuation.
Implied move into the print was roughly 4.5% based on the at-the-money straddle. The actual move on a 6 to 9% rally means options sellers got run over and dealers are likely chasing gamma into the next session.
Put-call ratio coming in was roughly 0.85, modestly skewed toward calls but not euphoric. That's consistent with a name where institutions are positioned long but not crowded.
Insider activity has been quiet over the last 6 months. CEO Tim Donahue holds a meaningful position but hasn't been a heavy buyer or seller recently. No Form 4 cluster either direction in the last 90 days.
That neutrality on insider flow is constructive. You'd rather not see selling into a print like this, and the absence of meaningful buying just reflects that insiders are already long enough through their equity positions.
The bull case got direct support from Q1. Energy drink volumes drove the beat, margins held through aluminum, Europe didn't deteriorate, leverage continues to roll down, 4 for 4 on the bull pillars in a single quarter.
The bear case got partial support too. Margins didn't expand, they just held. The operating leverage upside the bulls want to see is still ahead of us, not yet fully visible in the margin line.
For the market to be right, paying 12.5 times forward, you need to believe the trailing EPS roll continues, the buyback restarts in 2026, and Europe stays at flat, not down. That's a believable set of conditions after this print.
My read is the bulls have the cleaner argument right now. The bears need a specific catalyst, an aluminum spike or European rollover, and neither showed up in Q1.
The asymmetry favors longs into Q2 and Q3, which are the seasonally stronger quarters. If Q1 prints 186, Q2 and Q3 should print closer to $2.
Consensus is split between buy and hold, leaning buy. Roughly 20 to 22 analysts cover the name. Truist Securities at buy, maintained in April. Wells Fargo at equal weight. Citigroup at buy. UBS at neutral. Deutsche Bank at buy.
Average price target sits in the 118 to 122 range preprint. After today's beat, expect upward revisions, probably moving the average toward 125 to 130 as estimates roll higher.
Dispersion is moderate. The bulls have targets in the 130 to 135 area. The cautious analysts at 110 to 115. Nobody screaming sell, nobody screaming strong buy. That's a healthy setup.
The equal weight and neutral camp will be under pressure to revisit. When you maintain a hold and the company beats EPS by 6% and revenue by 7.5%, that rating is on borrowed time.
Watch point 1. America's beverage volume growth rate. We need to see continued mid to high single-digit volume growth quarter over quarter. If that decelerates to low single digits, the energy drink thesis weakens materially.
Watch point 2. Net debt to EBITDA trajectory, currently 2.6 times. Track this every quarter. The buyback restart trigger is below 3 times, and we want to see continued progress, not stagnation.
Watch point 3. European beverage segment commentary. Listen for management language on volume and pricing. Flat to modestly positive is the bull case. Any softening to down low single digits changes the narrative for 30% of revenue.
Watch point 4. Capital allocation announcements, a buyback authorization, a dividend increase, or a tuck-in acquisition each carry different signals. The market is positioned for repurchase. A surprise deal would be the bear scenario for sentiment.
My bottom line, Crown delivered the cleanest possible Q1 print. Dual beat in the seasonally softest quarter, every segment cooperating, leverage continuing to fall. The forward setup is the strongest it's been in 2 years.
My bottom line, the valuation gap to ball at 12.5 versus 16 forward is too wide after this print. Energy drink compounding plus a 2026 buyback restart is the catalyst path. Risk-reward favors longs here.
This content is for informational and educational purposes only and should not be construed as financial advice. All investments carry risk, including loss of principal. Do your own research and consult a licensed advisor.
For full episode notes, chart packs, and our complete coverage universe, visit chargedalpha.com. We publish new episodes every week. Hudson and Lana, signing off.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.